Hi, it's the Tax Geek again with more of your taxes oversimplified. Today we're going to look at the Qualified Business Income Deduction and its effect on the taxes small business owners pay. The 2017 Tax Cuts and Jobs Act reduced the income tax that traditional corporations, or C corporations, paid on their net incomes. The framers of the act wanted to provide similar relief to smaller businesses that were not traditional corporations. Thus, the Qualified Business Income Deduction was born. To be able to understand the deduction and how it is calculated for most businesses, we need to define a few terms. The first is qualified business income. This can come in several forms: net income from a sole proprietorship, a partner share of the profits from a partnership, or a member share of the profits from an S corporation. Sometimes you even have qualified business income on a 1099 DIV form with a designation Section 199A income. In the case of net income from a sole proprietorship or share of the profits from a partnership or S corporation, the net income is reduced by the following adjustments to income: the adjustment for 1/2 of self-employment tax, adjustments for contributions a self-employed person makes to a retirement plan, and deductions a self-employed person can take for purchasing health insurance. The other thing we need to define is ordinary taxable income. This figure starts with the taxpayer's adjusted gross income, subtracts any capital gains they may have, and subtracts either the taxpayer's standard or itemized deductions. The calculation for the Qualified Business Income Deduction changes when a taxpayer reaches one of two thresholds: the low threshold and the high threshold. Here are the low and high thresholds for the various filing statuses. This video focuses exclusively on taxpayers with ordinary taxable incomes that are less than the low threshold, which make up the overwhelming majority of small business taxpayers. Calculating qualified business income deduction for taxpayers with ordinary taxable income above the low threshold is so complicated it thwarts any attempt at oversimplification. So for those taxpayers whose ordinary taxable income is under the low threshold, here is how the qualified business income deduction is calculated. Take 20% of the qualified business income, take 20% of the ordinary taxable income. The lower amount is the qualified business income deduction. Here's an example. Kimmy owns a hair salon and her net income from the business is $53,000. She contributed $1,500 to her retirement plan and paid $6,000 for her health insurance. Her adjustment for self-employment tax is $3,744. By the way, if you want to know how that was calculated, click on the card above or the link in the description. After subtracting these adjustments, her qualified business income is $41,756. Now we need to calculate her ordinary taxable income. Since she doesn't have any capital gains and she has no other sources of income, her adjusted gross income is the same as her qualified business income. Kimmy is single and uses the standard deduction, so her ordinary taxable income is her adjusted gross income of $41,756 minus her standard deduction of $12,400, which equals $29,356. This figure is well below the low threshold. To calculate the deduction, we first take 20% of her qualified business income of $41,756, which is $8,351. We then take 20% of her ordinary taxable income of $29,356, which is $5,871. This figure is less than the $8,351, so $5,871 is her qualified business income deduction. In general, taxpayers whose business is their primary source of income will base their qualified business income deduction on ordinary taxable income, and those who have a small enterprise on the side will have their qualified business income deduction based on qualified business income. Let's see how that works. Bill has a full-time job which pays $45,000 and nets $3,500 from a ride-sharing gig. He is single and takes the standard deduction. His qualified business income is $3,500 less his adjustment for self-employment tax of $247 or $3,253. His ordinary taxable income is his wage income of $45,000 plus his net rideshare income of $3,500 less his self-employment tax adjustment of $247 and his standard deduction of $12,400, resulting in $35,853. 20% of his qualified business income is $651, and 20% of his ordinary taxable income is $7,170. Since $651 is less than $7,170, $651 is his qualified business income deduction. Qualified business income deduction is calculated on a Form 8995, and the result is carried directly to line 13 of Form 1040. If you have multiple business activities, they are combined onto a single Form 8995. If you have business losses, they are carried into future years to reduce any future qualified business income. You may hear some other terms bandied about when discussing the qualified business income deduction, such as specified or non-specified business, W-2 wages, or unadjusted basis of business assets. These terms are irrelevant to taxpayers whose ordinary taxable incomes are below the low threshold and thus are not discussed in this video. Of course, this just scratches the surface on this subject, and more details, especially for taxpayers with incomes above the low threshold, are in the links in the description below. If you found this video informative, please give it a thumbs up and subscribe for more content. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and stay tuned for more of your taxes oversimplified.